presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for August 31st, 2021. I just wanted to do a quick update, bring you up to date for the month end and let you know what happened and what to expect in the markets. Let's start with all the COVID relief and all the COVID, the Delta variant that everybody is talking about. For the last 2 months, I've mentioned that we might go through what the UK went through, where they saw a tremendous surge, and then they started to drop off. And that's what we're starting to see now here in the United States as more people get vaccinated and we move towards herd immunity. So that is the good news, that the 7-day average is starting to come down. We did see, unfortunately, a rise in the death rates, but that is also starting to come down at this point. We do have 363,000 doses of the Moderna and the Pfizer vaccine combined administered, and you can have some of the Johnson & Johnson also out there. So looking at all of that, we're moving slowly towards herd immunity. We are getting there, but we are not there yet. There could be some more, unfortunately, younger people getting infected, but the chances of them getting hospitalized or having bad outcomes is very small, and I'll show that to you in a minute. Once we get past COVID, or at least, as I've called it, an endemic rather than a pandemic, where we are learning to learn with it, in the short term it could cause some wobbles and some concerns in the market. Some people have curtailed their travel plans and the vacation plans. Other people have cut back from going to crowded locations, and that might have a short-term impact, I believe. But once in the next couple of months, I think we are going to also get past that. I do not expect any hard lockdowns. Politically, that is not something that is palatable at this point. Looking at the numbers, if you look at the reference group of 18 to 29-year-olds, if you get COVID, unfortunately, the bad outcome is 600 times if you're 85 years old. It's 230 times if you're between 75 and 84, and 95 times worse the outcome could be if you are between 65 and 74. But as we get down in these numbers, the fatality and the hospitalization rates come way down. So we are seeing younger people getting infected, but the outcomes are not catastrophic or dire. That's really the good news out of this whole thing. And more young people are moving towards vaccinations also at this point. Looking at the reopening, we are reopening. We're higher at the staffing levels. We're looking at weekly retail sales. They're positive, higher than they were in 2019. We're looking at box office receipts are still down, but they're starting to come back. Real traffic is definitely coming back. We're looking at steel production is about the same now as it was pre-COVID. Hotel occupancy is coming down. TSA checkpoints, still not as many people traveling, but we are getting back to that 2 million mark where we were for the holidays, and I think over the next holidays we'll get back up there. Gasoline usage is down very fractionally. We might see some problems with Hurricane Ida, but that I think is transitory and will be short term. Global commercial flights are still down, and we're seeing that the numbers there is still not what we expect to see. So it will take some time for us to get back up. The big news last week was the Fed Jackson Hole announcement and the meeting there. It usually is at Jackson Hole. All the chairs of the central banks meet there. It was done virtually today, on Friday. We did see a speech. We did get the speech from Jerome Powell, the chairman of the Federal Reserve, and what he said is that they are ready to taper. He did not give us the composition of the taper or when it is exactly going to start, but he said the conditions are there that they are going to start tapering. That means they're going to start cutting back on the bond buying program. The expectation is that they're going to announce the composition and timing at the September FOMC meeting. That's the Fed Open Market Committee. That will be announced somewhere at the end of September at the next meeting. The expectation is that they are going to start tapering somewhere in November or December. That means they're going to reduce from 120 billion. It is going to be a gradual process. But with that, in that statement, the dovish statement that the chair made was that he does not expect any interest rate increases. The requirements for interest rate increases are much more stringent. That means that he'll keep rates lower for longer. And with that, the market I think the market is prepared that it's not going to get the 120 billion. That is going to be reduced over 2022, but it is not going to be any quick interest rate increases. We could see a problem with that if we do see inflation continuing to rise, but I believe that the Fed is going to tolerate higher inflation numbers at this time. They're not as concerned about inflation. The chair has said that, the chairman of the Federal Reserve has said that it is transitory, and that is the expectation. I believe that that is going to be the case. We are going to see some elevated inflation rates going into 2022, and some of the rates might exceed the 2% target that the Fed has for inflation. But the Fed will say, well, it's running higher, we'll give it time, it's catching up with all the years that it was below 2%. So they might look at an average of the last 2% and justify higher inflation rates, like Mr. Bernanke did when he was chair of the Federal Reserve. He said he's going to raise interest rates when unemployment fell to 6%. It went to 6, 5.5, 5, 4, 3.5. He just said, no, it's still okay. It's not causing inflation, so we'll keep rates. I think they're going to use the same sort of language as far as inflation is concerned. The big number is unemployment. That's what the Fed is concerned about now. They want to see unemployment numbers coming back up. We do get the unemployment numbers on Friday, which will give us the August unemployment numbers. The expectation is that'll be about 770,000 jobs created. If you get a number higher than that, that could cause some anxiety in the market that the Fed might move up the taper or might taper faster. But if it's a number somewhere around that, and the numbers that we are going to get from the ISM, the Institute for Supply Management, that we get on Wednesday and then again on Friday, one for the manufacturing sector, one for the non-manufacturing sector, those are expected to be okay. We did see consumer confidence go down, and that could cut back a little bit on retail, and that could cause some anxiety in the market in the short term. But I believe that is a short-term anxiety. It could cause some short-term pullbacks, and that's what everybody has been looking for, is that pullback in the market. We have not seen that. Looked like we are going to get to that 4430, 40 area. We got there, pulled back from there, and now we're above 4,500, headed towards 4,600. I was thinking about this in quite a bit of detail, and when you look at the capitalization model of the market, you take the earnings that the market has made, and you've heard me for the last 30 years talk about what drives the stock market. The more money companies make, the more valuable the stock of that company becomes. The more money the S&P 500 makes, and that is measured by the earnings per share, the more valuable the S&P shares become. So you take the earnings per share and you divide that by the interest rate on the 10-year note. That's the cap model. It gives you a fair value of the market. If you take a 1.3% number where we are on the 10-year note, that number becomes astronomically higher. Even if we take a 2% number for the 10-year interest rate, it gives us, with that cap model, a much higher value for the S&P. That's why I think we could get to the 5,000 number for the S&P by the end of this year, and that would still be below the cap rate of 2% with the 10-year note. That's why I think we can justify higher numbers. It's what are the alternatives besides the real estate market, which has done very, very well. But the real estate market is not a liquid market. You cannot get your money in cash any day you want to. In the stock market, it is there. So I think there is room for the market to continue moving higher. There are some cross currents that we could see tax increases from the Biden social infrastructure plan, the $3.5 trillion that they're talking about. I think that will be trimmed down dramatically. We'll have to wait and see how much that is. If it's about $1 trillion and $1 trillion comes from taxes and another $1 trillion from deficit spending, I think the market will be okay with that. But if it's a much larger number with much higher taxes, that could be a problem for the market. So we are going to get that in the next month, month and a half, and I think that is going to be the main driver, plus the tapering of the market on the fundamental side. Looking at the technical side of the market, Don't forget, by the way, you can tune into the daily broadcast every day that I do a 1 hour broadcast on Market Wrap. You can get the app simply by going to the App Store and typing in Market Wrap with Mo, and you will get the app for free, and it will be downloaded to your iPhone or your Android phone. Taking a look at the technicals, we are still above. Support is at the 50-day moving average, which is at 43.90. This is the 50-day. Then we also have the 20-day moving average, which is around 44.60, and the market closed today at 45.22. So we're just continuing to grind higher. But September historically has been a worse year in the market from a seasonal perspective. We'll have to wait and see how September plays out in the next month or so. Looking at the weekly charts for the S&P, 4,600 is the first target, and then we get higher target support around 4,400. Again, that's the 50-week moving average, and that is, again, I think going to be support in the market. Looking at the Nasdaq daily chart, we are looking at a chart of about 16,000 as the target. We closed it at 15,259 on the upside. Support is around 14,700 for the 50-day, and then we also have support at the 14,870 number. We closed at 15,250. So market just continues to move higher. The earnings are looking good, and that continues to move the market to the upside. Looking at the weekly charts of the Nasdaq, the target becomes for the third wave somewhere around 16.4, support at 14,335, and then 13,346. Those are the numbers we get on the downside as support for the market on the Nasdaq on the longer term. Just looking at the technicals, the market looks like, as the old saying goes, the trend is your friend, and the trend is to the upside. When will we get a pullback? When will we get the correction? That is very hard to judge. That is something what I call a fool's errand, trying to find those little wobbles in the market. And that unfortunately gets people out of the market, pushed out of the market, that it can't go higher. We've heard the same thing for the last decade, where the market cannot go higher. This year alone, we've made 53 new highs for the S&P as of today, and the market just continues to march higher. So don't try to predict how high this market is going to go, when the correction is going to come. You have to keep an eye on the overall fundamental structures of the market. Fundamentally, overall, the economy looks healthy. The economy is growing. We are getting past COVID, though slowly, and we've had some problems with it, but I believe we are going to get past it, and at this point, we're looking at the market moving higher. We could get corrections at any time. The gold market has been disappointing. It's above the 200-day moving average finally. A resistance is this high above at about 1960. Support is this triple bottom that we've seen around 1675. We made a triple bottom here in the gold market. But if interest rates go up, that pushes the dollar higher, and that puts pressure on the gold market. I expect the tapering announcement is going to have some impact on the interest rate market, and if interest rates move higher, for gold to move higher will be a difficult proposition. If inflation takes hold and it continues to move higher, that could push the gold market higher. Or if we see COVID getting worse or some geopolitical event, that could help gold. But those are, again, the probabilities are small. I still think there's better opportunities in the stock market rather than the gold market. You've heard me have that opinion for the last few years. That's why I have not been in the gold market at all, and that is still my opinion at this point. As far as the emerging markets, they have popped back up after going down all the way down to about 49. They're back up to the 50-day moving average, and then which is around 42.63. We closed at 52.41. 52.63 is the resistance, and we're very close to that. If we can get above the 200-day at 53.31, I think that will be a sign that finally the emerging markets, but it is the small caps which really show me the reopening trade, and that is the Russell 2000. That has been in a broad range. That has been the top in the market for about 7-8 months. On the bottom, we've had this broad range of about 2160. That is something, the bigger the base, the bigger move, as the old saying goes in the technical jargon. And we are looking at closing today at 2273. We're not at 2360. If we can get above this target of 2360, that would clear us to 2500 and maybe even higher numbers than that. That will confirm to me that the reopening is here and it's here to stay. That's the small cap index indicating that. And that's what I call the days we have reopening, the small cap is up. The day we have worried about COVID, the technology stocks are up. That's what we have seen going forward. Lately, the technology stocks have also gained strength because of interest rates not going up. Instead, they came down. We did have one of the biggest increases since March this month in interest rates, but they are very small. They went from 1.12 to 1.3 for the 10-year note, which is not a big increase. Looking at the weekly charts, as I mentioned, if we can get above this big base that we've built, this is going back to nearly the beginning of 2021, we can get above this, that'll clear us to about 24, 25, and then the longer term target becomes 2850. We're at 23 on the small cap. So that's where I think the reopening trade resides. Once we get past 2360 decisively, that'll show me that we are finally, COVID is basically something that we've learned to live with. We have enough people vaccinated. We're getting closer to herd immunity, and then people take the precautions, but at the same time, we will be fully reopened. That's the way I'm looking at the Russell Small Cap Index. Don't forget to subscribe to this. Whenever I do, just click on the button right there and subscribe, and whenever I do an update, you will get notified that you have an update that you can watch. Again, thank you for tuning in. I hope this gave you some food for thought. If you would like to get our help, always you can contact us at compak.com. My staff is standing by, my team is standing by to give you some answers. Evaluate your risk, your emotional risk profile, your financial risk profile, marry the two and give you a solid plan to go from where you are now to where you want to go financially. All you have to do is go to compak.com and click on Make an Appointment. They're all free. There's no cost or obligation, and we will be more than happy to set you, at least point you in the right direction. That is my update. Those are my thoughts as of August 31st. Thank you again for tuning in.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.